Joining us now for more, Dan Niles, founding partner at AlphaOne Capital Partners. Dan, great to see you. Thanks for joining us.
Oh, my pleasure, Wilfred.
I wanted to start, if I may, on the jumps we've seen in the likes of Tesla and Apple after announcing stock splits. Do you think those jumps were purely because of the stock splits? And does it worry you in terms of what it suggests the levels of valuations we're at?
Yeah, I mean, if you look, I think, at Tesla in particular, there was no earnings announced on that day, right? The only piece of data you got was they were splitting the stock, and the stock took off. And so there's no economic value added from that. And so I remember seeing similar things when you go all the way back to 2000, where metrics or things that were said that didn't matter, drove stocks up tremendously, like a company changing its name and adding .com behind it, and the stock will go up a tremendous amount the next day. And so, yeah, these are all signs of froth. But the thing I would say is that, there's a great phrase that the market can stay irrational for longer than you can stay solvent. So, these stocks are up 20% off of a stock split. Could they go up another 20%? Sure, because you're already at record valuation territories, and there's nothing to say that it can't get more insane from here. So I think that's the thing you have to think about, because valuation is a very poor timing tool. It's a very good tool if you use it in conjunction with fundamentals that might be getting a little bit rockier. And so that's how I think about that in sort of a package.
As for the stocks that do have valuations, Dan, so kind of moving away from Tesla as a specific example, clearly there's a lot more people entering the market for the first time, whether that's because they're enabled to do so on their smartphone or enabled to do so from stock splits or free commission-free trading. And clearly there's a lot of money being printed by central banks all around the world. Does that drastically alter what a reasonable valuation will be for all stocks for the next decade as compared to the last decade?
Well, for the short term, it does. But I mean, one thing I would remind people is that we take a very U.S.-centric view. And, you look at the dividend yield at 1.7%. I think you had a guest on earlier saying, there's nothing else to invest in. But you compare that 1.7% dividend yield or so against a 26 PE for the market. If you kind of move a little bit overseas, I mean, Germany's got a negative 0.4 rate. Switzerland's got a negative 0.4% rate. They're both, obviously very stable countries. They've got dividend yields close to 3% around that level, and the PEs are about 20 times. So 20 times versus about 26 times. Even Japan, which is obviously, a very stable country, same situation, much higher dividend, and I think the PE there is at 23 times, and they've got basically, no yield on the 10-year. So valuations, if you try to step outside and just look at it holistically in the U.S., they're extremely high. And, we're going into a contentious election. Obviously, the stimulus package is sort of dragged on, I think, longer than most people think, but it's clearly going to come down from that $600 extra a week. And so these are all risks. And, you can walk in on any given day and all of a sudden seeing the market getting hit like it did on June 11th. I think it was down 6% in a day because for whatever reason, people wake up and go, you know what? Cisco talked about small and medium businesses being down 23% year over year in orders, accelerating from -11. Microsoft talked about small and medium businesses having an issue. And those are fundamentals combined with high valuations. You have an issue. So I think investors need to be more balanced than looking at just stock splits and saying, oh, that's wonderful, and driving things higher.